Hello, everyone. I am Michael Mruger. I am the managing partner of Greenbush Financial Group. The topic we're going to be covering today falls within the estate planning category, specifically for residents of New York, because New York has all these special estate tax rules that vary from the federal rules. And one of the big ones is the cliff rule in New York State. So once estates get above a certain dollar threshold, there's actually no exemption in New York State, and the entire estate becomes taxable at the state level. The other is we have special portability rules where portability between the two spouses that creates an issue that if proactive estate planning hasn't been done prior to the first spouse passing, millions of dollars worth of state tax exemptions can be lost. We'll start off by addressing the cliff rule that's specific for New York State. So it's important to understand that when we talk about estate tax rules, there's different rules for the federal level and the state level. And some states just adhere to the federal rules, but New York State is not one of them. So when people start doing the research, they see this $13.9 million estate exemption at the federal level, and they're like, oh, I'm not over $13.9 million, so that means I'm going to be fine. But if you're in New York State, you may not be fine because the estate tax exclusion in New York State is only $7.1 million in 2025, which is essentially half of the federal exemption. When we're doing estate planning for clients that live in New York, there are essentially three tiers of estates that you have to be aware of to determine whether or not you have a state tax liability issue. The first tier are the clients that don't have to worry about paying either Fed or state tax. The second tier are the ones that have to worry about paying some state tax. And then the upper tier are the ones that could potentially have to pay state tax on everything. Let's start with the bottom tier that owe no state tax. So New York State has an individual per person exemption in 2025 of $7,160,000 per person, that as long as your estate assets are below that level and you pass your assets on to your heirs, you do not owe any tax in New York State. The second level are for individuals that pass away in New York State that have estates between $7,160,000 and $7,518,000. For those individuals, they have to pay New York State tax only on the amount that exceeds the $7,160,000 threshold. The top tier is where the cliff happens. At $7,518,000 and above, there is no longer an estate tax exemption within New York State, and that entire estate is subject to taxation, which in New York can range from 3.06% to 16% in taxes, depending on the size of the estate. Which is why they call it a cliff, because if you go over that threshold by $1, now the whole estate is subject to taxation. Now we're going to move on to the second issue within New York State estate tax rules, which is our lack of portability of that state tax exemption. And what I mean is, at the federal level, that $13.9 million, there's portability, which portability is just another word that says if the first spouse that passes away does not use all of their exemption, their unused amount gets to pass on to the surviving spouse, and they get to use theirs plus the unused amount from their spouse. This portability issue is important because most married couples title their assets jointly, their houses, their brokerage accounts, their savings accounts. And what that creates is when the first spouse passes away, everything seamlessly transfers over the other spouse, which doesn't seem like an issue. It doesn't create any state taxes or anything like that. But the problem arises when the second spouse passes away. Now, the way portability works at the federal level is, let's say they have everything in their joint names and spouse one passes away. If they didn't use any of the $13.9 million at the federal level of that spouse's exemption, the surviving spouse then gets to port or inherit their spouse's $13.9 million. So when they pass away, they now have $27.8 million that they can use to shelter assets from the federal estate tax. Because New York State does not allow portability of that 7.1 state tax exemption amount, more advanced planning has to be done, because if everything's in joint name and everything just transfers over the surviving spouse, that $7.1 million does not get inherited by the surviving spouse. It just gets lost. Here's a quick example of how this would work. So let's say Larry and Kathy are married and they have an estate valued at $10 million. And most of their assets are titled jointly with rights of survivorship. If Larry were to pass away in 2025, since everything was titled jointly, the $10 million in assets just transfers over to Kathy, no estate tax due either at the Fed or state level. The problem arises when Kathy passes away 2 years later. Assuming Kathy passed away with that same $10 million in her name, there's no federal estate tax due because she's more than covered by the $27.8 million exemption at the federal level. However, because New York State estate tax exemption is not portable and her assets are well above the $7.5 million cliff, the full $10 million would be taxed at the New York State level, resulting in close to a $1 million tax liability. Now, if instead Larry and Kathy did some advanced planning and instead of holding all their assets joint, they segregated their assets where $5 million was owned by Larry and $5 million was owned by Kathy, now when Larry passed away, he would be able to use his $7.1 million New York State exemption to protect his $5 million. And then when Kathy passes away, her $5 million 2 years later would then be able to use her full $7.1 million to exempt it from state tax, resulting in a zero tax liability to New York State. And paying zero taxes versus $1 million is always a good thing. One of the common solutions that our client used to get around both the cliff issue and the portability issue of New York State is to set up separate trusts in each of the spouse's names. So not only do the assets avoid probate, but they can maximize their New York State estate tax exemption. And I will sometimes even hear clients say, well, I don't have to worry about it because my estate's only $6 million. We're below the threshold. But if that client that says that is only 70 years old and they're both in good health and they're planning to live another 20 years, they might not have a problem now, but what happens 10 or 15 years from now when now their estate assets have grown to $9 or $10 million? Now there's a problem. I hope this information was helpful. If you have any questions, please feel free to reach out to me at greenbushfinancial.com. A special disclosure on the end of this, I'm a certified financial planner, not an attorney. For legal advice, please contact an attorney.